Hi, David. How are you? So nice to see you again.
Oh, it's great that you have me. I'm an avid listener to the podcast, and I feel really privileged to be on the show. So thank you for having me.
Oh, what a pleasure to have you here. And you and I met at VALUEx, at Guy Spier's VALUEx in Clusters, and you had some presentations there that stirred up some discussions, and you got a lot of questions and a lot of feedback. And I thought, oh, I'd love to have you on the podcast and ask you more questions about the kind of work you do. And you gave me a glimpse of that in various times that we spoke, but I thought it would be nice to sit down for a solid hour or more and talk more about it. And we, even before I hit record, we started talking about your work style and life design, but we'll come back to it. David, I want to jump right in, and I like to ask my questions about those early days because I think a lot happens in those early days. So if you indulge me, can you talk about your childhood upbringing and how you think that time shaped you, your interest, your curiosity, and also your relationship with money?
Sure, I'm happy to do that. I was born in Munich, Germany, and raised in a village, let's say 30 minutes away from it, where I still live. So those roots are deep, I think.
Uh-huh.
Yeah, my childhood experience was, let's say, very free. I mean, most of the time playing sports, especially football, or in the US you would call it soccer,
Mm-hmm.
and playing with my younger brother outside. Lots of playing outside besides school. And I think money, like the relationship to money was never an issue with our family. I would say I've been raised in a German middle class family. Money was never an issue, but it was in no way abundant. So, but as a young child, you don't really care about it. So, no, I was busy playing football, and my brother and I we both played at a very like we would always say professional level, but in as a in high school you don't get paid, so it was basically go to school and have practice in the evening or afternoon, and on the weekends you drive around Germany to matches and play. And this was basically my life from being 5 years old to let's say 16 years old. Then I'm at the junction, you would say, because I recognized that I wasn't good enough to be a pro footballer.
Mm-hmm.
It's quite competitive, and I realized, okay, in Germany when you go to high school you end around you have 11 years of school if you make a high school degree, and it was like I had 2 more years, and it got serious, and I thought, okay, maybe I put more effort into school. I mean, I was always I would say a good student, but not a very good one, and I didn't put too much effort in it. Yeah, and then I kept on playing until like 3 years ago, but let's remove the overhead, let's say.
Mm-hmm.
So, and I think until until then I never had we don't have any investing background in my family. There is no one I can name, or I know that has been an investor. Although I would say I was raised in a family with, let's say, solid personal finance background, so budgeting and don't spend more than you can earn. So
Mm-hmm.
that was pretty good. But I mean the interest in math has always been big, so I've always been a good math student, and it's numbers and mathematical concepts always felt quite easy, or let's say easy, but I was comfortable with it. It was never too difficult to understand, and I always had an allure or an interest in solving riddles. Like I always did after school with my grandpa the crossword puzzle in the newspaper, and with my with my grandma there's always been some numbers puzzle, and I did that. So there has always been some interest in numbers, and I really didn't exactly know what to do after school, but I've always been very competitive. So in Germany, I mean, you don't know it, but in Germany, universities, I would say, basically free. The fees are very, very cheap. So basically, after you finish high school, you go to university, and we have very good universities in Munich. And I had pretty good grades, but if you want to be go to become a doctor or a lawyer, you
Mm-hmm.
need really good grades, because there is no tuition. It's by grades, so they just judge you how good your grades are. I mean, we're good, but not that good. But if you study then, let's say, computer science, physics, and mathematics, like everybody can join, because the way they do it, there is not that much interest, and the exams are just so difficult that after the first semester, like 80% drop out or fail, and like said, okay, I like math. It seems like a challenge, and I'm up for a challenge. And this is where I studied math. And you need the major in math, but you need a minor. And there I choose business because this was a very simple thought. Say, okay, you have to work somewhere later, so maybe it helps to learn about business. And as the studies progress, like, I mean, the usual way would be you make your bachelor's degree in business mathematics, as I did, and then you go into mathematical finance as a master's degree, and then you become either a portfolio manager at an asset management firm, or you become an actuary in an insurance company and price the policies. So at that point, I made it through the first 2 semesters, luckily, and actually 80 to 90% dropped out, so very few people in the room. But then you start having the mathematical finance lectures where you learn about options pricing and the mathematical models behind it. And that's where I basically started working as a student for the asset manager of the Munich reinsurance company. Like, it's one of the biggest reinsurance companies. And there I got into investing. Like, it's a very, very different kind of investing that I now practice and that you practice and many of our friends practice. But that's where it came. And I thought, okay, well, if that's my career, I better learn about it. And then I have no point in time or moment where I learned about value investing, but I picked up Warren Buffett and just learned about investing. And it appeared to me like that this kind of investing was way more intuitive for me, or it just made a whole lot of sense. And the way that I learned in university, and also that it's practiced at most large asset managers, especially in the insurance industry, because what they usually do is, the German ones, I think Berkshire, the way they do it differently, but they just match the liabilities of the insurance. So it's a lot of correlation, and you try to hedge it, and so you use the mathematical models, but it never seemed to make a whole lot of sense for me. So. And that's also where I chose to not go on to study mathematical finance, because I said, no, I don't think the asset management industry is something for me. And that's where I actually chose to do data science, because I said, okay, you studied math. What can you do with math? I mean, you can manage money, but also it turns out that machine learning and AI, it's basically math and statistics at scale. And I thought it doesn't hurt to learn programming, and doesn't hurt to learn about all those algorithms, and had an interest in it, and this is why I chose to study mathematics and data science in my master's. But always kept the interest in investing, and always I read a lot of books. I started investing my own money that I made as a student. And learning by doing, read annual reports, listen to podcasts, and just learn as you go. And this has been 6 years ago now, and that's where I am now. And I mean, I finished my studies. Now I work as a data scientist and machine learning engineer for IBM as my day job, and invest my own money, and started writing the blog 6 months ago about basically my investments. I write up my thesis and share some, let's say, investment philosophy pieces that I think about. And one thing met another, and we met at VALUEx. I mean, and now I'm here, and still, what a journey.
No, I love it. I have so many questions because you brought up so many fascinating little snippets of your story. I personally found comfort in math and numbers, and I'll tell you why, and I'm curious if that was your experience. So I enjoyed school. I don't know if I was the best student. I think I was a good student. But I found comfort in math because if the answer was 2, it didn't really matter how I got there. It didn't really matter how long it took me. It didn't matter. Nothing really mattered. If the answer is 2, the answer is 2, right? And then I loved writing, and I still write, and I love your blog, and we'll talk more about your writing experience, but it was more subjective, qualitative in a sense. So somebody could read your essay, and they would say, well, this is a B or no, not an A. And then we would argue, why do you think so? Right? It was open for interpretation. But math, if the answer was 2, the answer was 2. Right? If anything, I had teachers come up to me after I gave them the answer, and they would say, well, we know nobody else got the answer, so you didn't copy it. But next time, could you show all 8 steps that it took you to get there instead of the 2? And my mind would skip, my mind would get to the 2 quicker. And I found it fascinating that my teachers wanted to know, all those 8 steps. Okay.
That actually resonates a lot because usually I had that where I got less points because I didn't put the full explanation into the solution because it seemed obvious to me, but obviously it's not. That's where what you learn in university, because math university changes a lot because you have to prove everything. It's completely different than in school because it's way more theoretical. You have to prove, and the proof has always to be, you cannot rely on anything. You have to prove every little step, which was very helpful to me. And I think that we can talk about that too, how that influenced how I invest, because you start from first principles. I think that's why it's so tedious, because in the first semester of math, you're not allowed to use any common knowledge. You're only allowed what you start in the first lecture, and the first lecture is basically you have a set of axioms that math is built on. It's just you have a set, and then you can combine the set and cut it and form a union, and that's it. And then you start to prove everything that we use in mathematics. But you're not allowed to use anything of it, so it's very, very tedious. But it's also, you learn how it rewires your brain, because you learn how to think for yourself, how to think from first principles, and build from that, and go to the core of the issue. So I think that's insanely valuable.
But it's a certain framework that I think helps in investing, math and numbers. And I think some people are intimidated by it because they think you need advanced math to understand investing. I don't think it's the case. I think it's really relatively basic math, but you have to be comfortable with numbers. Don't run away when you see numbers. They can actually tell you a story. And speaking of stories that the numbers tell, and I have a couple of questions about it, but I want to focus on the idea that you write about and inspired your blog, which is the contrarian cash flows. And you look for contrarian cash flows. So I have two questions. Why contrarian and why cash flows?
Well, first, I think if you're looking for a title for your publication or a blog, I think an alliteration helps. You always take a contrarian position, and I think I don't think many people recognize, because if you look, you could argue that what many people say is quality companies, and they say like very predictable businesses. If you buy into the business and it's predictable, like, where does the excess return come from? And right. I think you always have to think about that, and I don't know many people do it. So that's absolutely, obviously, where the contrarian part comes from. Yeah, and the cash flows it's more about how, there are many ways to make money in the market, and also in value investing. You can, people invest like in asset play, where they say, okay, basically or nets, like what is just the raw asset of the business worth, and don't really look at cash flows or look at private public comms, like what would be an intelligent private buyer take the business over. But what I'm focusing is just, if I buy the business and only get the cash flows from the business and don't get any re-rating in a multiple and have to own it for a long period of time, like what is the return I can get from the business, from the cash flow that is returned through buybacks or dividends and through the growth. So this is, I think, where the both components come from, and that it's the major influence of the investing style or the investing that I do.
It boils down to the main question: why would you own stocks, right? And I think people get into investing because they see something that moves up and down in price, and it's attractive. It's like a cat following the little mirror reflection on the wall, up and down, up and down. But if you actually start to pay attention, what is it that you buy? And if you see stocks as small pieces of businesses and you see yourself as an owner, then you ask yourself a follow-up question: why would I own a business, right? Well, you would own it for the profits that it can generate. Profits, cash flows, different ways of looking at it, but basically, how much money can I get back as a shareholder of the business, whether the money is reinvested or paid out to me, but it is created year after year. And you have a good point that a lot of people are watching the market, a lot of people are doing their analysis, and what's your edge? I do think that we interpret information in different ways, and I'm sure we'll talk about it. So I think there's an edge there, but I think the true edge happens in what you highlight in your writing, which is the contrarian aspect, which I like. So I have a list of companies I'd like to own at some point, but I buy them when they're down cheap, out of favor, for some reason. And I'll come back to the nature of that reason in a minute. But talk to me about the contrarian aspect. I really like that idea of going in when other people are not interested. Where did it come from? Why does it appeal to you?
Now, the way I think about it is, where is your edge as an investor? And I think there are three edges you can have. I mean, the first one is an informational edge, the second is an analytical edge, and the third is a like they call it behavioral edge. And in the investments I enter or I go to, I try to have all three of those edges to varying degrees. But since you always have to ask yourself, like, why does the opportunity exist? And if you can answer those three questions, I think you have a better chance of not being trapped in something. So if we go through it, I mean, first the informational edge. I think it's very simple. I mean, if you have more accurate, better, or more information than other participants, you have an informational edge. The second one, an analytical, is more about, can you analyze the data better? Or I like to think about, have you a better mental model about the business? Like, is the way you think or understand of the business, is this better or superior than others? And I think a great example is Nick Sleep, the way he and his partner framed the scaled economics shared. I think this was just an analytical edge to think about businesses like Amazon or Costco, and this was truly an edge, and it was not informational or behavioral, it was an analytical, it was a better model to describe the business. And the third, I mean, it's called behavioral, but I would say behavioral does sound like it's only emotional, but I think I would call it structural. I mean, there are markets or region sectors where just the competition is lower, because I mean, if you think about large cap US, I mean, there are a lot of eyeballs, a lot of money chasing those companies. But if you go to sectors or regions, and also like smaller businesses, less liquid businesses, I think there is a structural edge for specific investors, because just the visibility, there is less visibility, and just less money chasing those businesses. And then if you have some sort of emotional aspect in the market, I think if you can align all three of those. And how does that inform my investment is, I like to look at businesses like smaller businesses and less liquid businesses, because what I like usually to have is a large portion of insider ownership. And if you have a low market cap and you have maybe the founder is still running the business and has 20% or 30% of the stock, I mean, then you have on top of that less liquidity, and this keeps many investors out. And what you end up is usually with retail investors or less sophisticated investors. And I also like to focus on what I call sectors or regions that are just out of favor or left behind. I mean, what I'm currently looking at is, I think Italy or Japan, I think are good examples. Let's say, culture more far away from Japan than from Italy, but I think both countries are very appealing from a valuation perspective, because I think many people think you can't invest in Italy because of corporate governance issues. And I mean, sure they are, but I think Howard Marks mentioned at one point what he always likes to think people or let's say the market says that something somewhere is not investable. Because then I think there's a huge opportunity if you put in the work and look at every single company. In this case, I think, and then you have the situation there. If you look at let's pick Italy. If you look in Italy at small companies with less liquidity, you're in a pretty good space already to find good ideas. I mean, you can argue that there are less good businesses there, but if you find one, then you have a better chance of actually getting. You have the contrarian perspective already, and then you have a better.
Well, I like the sound of that, and I like the contrarian aspect, and I like going places at times when people are not interested. I think the big advantage from my perspective is the time horizon. I manage money for wealthy families, and in my mind, in their mind, they have an infinite investment horizon. They're not in a rush. They're here to compound wealth over a long period of time. And I realize how many people are looking at the next quarter. They want to know if it was a miss or a beat by a penny. And there are fewer that stay there long term, but it means to them 6 months or a year. And I think by the time you get to 3-5 years, you might be the only person in the room still participating in the conversation. So I think that's an edge that I like to think of. David, I want to ask you about a certain word that you use in your writing quite a bit. That really struck me because I like that word. You use the word temporary. You talk about the temporary issues, temporary challenges. I'll talk more about it, but I'm curious about your thoughts. Why that word? Why it matters in your investment process?
No, that's interesting, and I mean we already touched upon like where you get your edge, and I mean I mentioned the first 2 points is like I want to have like some abandoned regions or sectors, and also like if you have low liquidity or low market cap, I mean that prevents competition. But I mean the third one, and or you can even argue the first two are temporary issues, because I think if a business executes, or a region or a sector, I mean it will be picked up by investors. So also this is kind of temporary, because if you think, I mean currently we can argue we are in a bull market in the United States, and I mean that for a significant period of time, but also I think after the 2000s, I mean more money flew over to Europe, so this is temporary. But so I think both, and also like low liquidity, low market cap, if the business executes, those are temporary issues, because as the business grows, usually the market cap grows, and with a high market cap there comes more liquidity. And I think the third point is more like actually what many people think about a behavioral edge. I mean, if there is some short-term hiccup in the business, usually the market, especially in the smaller businesses, I mean, they sell it out, bring the share price down a lot, because I mean, if you can argue if Meta had a bad quarter, or some bad quarters, I mean the share price declined quite a bit. But in smaller businesses, you have always the issue, I mean, is it really temporary issue, or is the competition just too strong? And I think, honestly, I prefer the first 2 points in just a region or a sector with low market cap, low liquidity, because those criteria are more objective. And I mean, if you get all three right, I think you can make a lot of money, because if you have an abandoned sector with low markup, and the business has some temporary issue, and then you have all three of those. But I think the last one is more tricky. But if you can figure it out, I mean, you look at the business history, you look at management, and say, okay, I'm invested in a small business. I wouldn't mention the name, but I mean they have currently go through some issues with their sales force. It's a customer relationship management company, a small one, and I mean I studied it, and then I thought, okay, this is really a temporary issue, because the CEO already mentioned they picked up the problem, and they already solved it, and now the growth should come back. And if you can find those, and then it's more, I think you can make a lot of money there, because if you hit the inflection point, like this is where a lot of the return comes from. But those are tricky. But I would say temporary more in all three, in broader time frames, 5 to 10 years, like where is currently a lot of money, where is currently the optimism, and like being like confident that this will shift over time, I think is where the word temporary, where I derive the meaning from.
No, I like that word, because it gives a context to what we're trying to accomplish, right? We were talking about long-term value creation, and I've been investing professionally for 20 some years, and I'm still mesmerized how short-term focused investors are, even professional investors. And I've been in rooms, in conversations, in investment committee meetings, and all kinds of situations, talking to managements along with other investment professionals, and I realized how something that is a passing issue can get extrapolated by the market, both on a negative side and a positive side, with the assumption that this is something permanent.
Yes.
So if it's a weaker quarter, if it's a delayed product launch, any mishap, you mentioned Salesforce, there's 1,000 different things that can happen to a living organism that a business can be. And you see how the investor base is focused on something like that and can bring down the stock price by 40, 50 and more % in a short-term period of time. So if you can take that long-term view, kind of that infinite investment horizon, or even a long-term investment horizon that exceeds 3-5 years, you could benefit, and you could have an edge that very few people can have. So that's fascinating to me, and the emphasis is on the word temporary. So much
and if I can jump in, I mean, if you think about it, you said even professional money is also very short-term focused, but I think if you think about it, I mean, professional money, if you manage money from individuals or institutions, I mean, your capital is only as patient as your investors are. And I mean, you can be very patient as a manager and have all the right traits.
Yes.
But if you're down 50% and your investors pull out, I mean, you're gone. I think maybe we talk later about VALUEx, but I talked to one of the participants, and he said like his fund blew up at one point, and he said because the structure was an issue. And I think you with your, I mean, your new business, and also I think the business you work for, the way you set up is, I mean, you have a huge advantage, because if you have the right client base with the right mindset, you can afford to be long term.
Mm-hmm.
And I think I think it's more a structural issue. I actually think that many managers are more long term focused, but I mean, if your client base or your capital base just does not allow you to wait 3 years, you're an issue, and I mean, you're down and out. And this is, I think, where many people, and also in our, what I hear a lot is the catalyst. Where is the catalyst? Because like they want to be long term, but they need something within a year, because usually you're judged within a year. So I think that's a huge issue, and I think as a money manager you have to think about that. And I mean, who am I talking to? You've mastered this, so this is what I take with me for the future, is to focus on that aspect.
Well, I think it's a learning experience for all of us, but you hit the nail on the head, because people look at investing as picking stocks that will go up. Then once you become a professional investor, you realize you're managing other people's money. It's a huge responsibility. You earn their trust. It's a relationship that you build. When I look at my clients, I think of lifelong relationships with people that trust me, with something that they can't replace. It's a family fortune. It's an inheritance. It's the sale of a business. It's capital they can't replace. They can't afford to lose it. And I think the biggest advantage at the end of the day is the clients, the capital that you can work with, that is entrusted to you, right? So if it's a patient capital, truly patient capital, that's where you can have a real edge. And the best opportunities are in times when it's a test for you and your client base. And a lot of funds get tested in times like March of 2020, when capital was flowing out of the markets, right? To be working with capital and clients that know exactly what it's all about. And this is the best, well, one of the better moments in terms of opportunity. I took calls from clients in March of 2020, and they would say, I just wanted to hear your voice and get back to what you're doing. You're probably buying things. And I was buying things because I was looking at stocks that were at 5, 10, 20-year low in March of 2020. And I certainly hope that window would last longer. It was a very short window. But stocks were coming to me, and I was very excited about it. Usually I'm the one that's waiting for them to come to me, and they were just running towards me, and I could pick and choose whatever I wanted. But to have the capital at that time to deploy, that's a huge advantage. And it's a very silent advantage that doesn't get acknowledged, or it's not visible until those moments. And I'm not talking about, a massive sell-off in the last 4 or 5 years. We had a couple of hiccups in the market. To have that capital stay with you through those times, I think it's very, very valuable, very important. And most of professional money invested out there, it's very short-term focused, very momentum-driven. It gets in the wrong time and leaves at the wrong time. Unfortunately, that's how it's set up. So patience is a huge advantage. David, I want to ask you about a couple more words that really stand out in your writing. One of them is, precision, perfection. And I feel like a lot of investors seek precision and perfection. And you have a different take on it. Could you share it? Why you think it's not all about precision and perfection in investing?
Sure. Happy to do that. Well, where my position comes from is I truly believe, or I'm pretty sure, that the world is probabilistic in its nature. Mm-hmm. So if you think about the environment, about financial markets, economies, I think many intellectuals or economists like to think about it as physical systems where you have equations you can precisely nail something. Or how often do you read sell-side reports with the price target is X, like it's a number.
Right.
But if you think about how the systems actually work, it's the economy, financial markets, and basically nature. It's a complex adaptive system, and I don't know how familiar you are with that framework. It's if you have a lot of agents that basically have behavior that adapt and that make decisions on their own, like you have, for example, in nature with evolution, but you also have in market. These systems have like specific criteria, and one of them is it's unpredictable. Like you can predict complex adaptive system, and the second one is like small perturbations or small impacts can have huge outcomes, and otherwise like huge changes in input can have only very little outcome. So, and I truly believe that this is how the world works. And also, if you think about psychology, and I think Daniel Kahneman wrote about that, is people, we're wired to think in narratives. So everybody thinks about if you have a stock pitch or everything, it's a story, like someone, and this is why we're here and this is where we go. And if you make a post-mortem or a case study, like, it's obvious that it turned out the way it did.
Right.
But that's not the case. We live in a probabilistic nature, and like there are a huge range of outcomes, and just because that one, even if that one occurred, it's not even sure that it was the most probable one. So I think to make decisions, it's way better to think in probabilities and not in like cause and effect relationships. And I mean, going through my math degree, I learned a lot about probability theory, and I mean, it helps to think. I mean, it helps to think in bets, and I think Annie Duke wrote a great book about it. So how to think probabilistically, and then you move away from certainty. And there's also like how I invest, how I think about businesses, and also like what I do in my writing. I mean, I think you read a couple of my write-ups. You won't, when I do the valuation part, you won't find like, say, this is the value, the intrinsic value of the stock. It's always like, under this condition, this is a realistic intrinsic value, and I usually do a range of outcomes or a range of conditions, and to think about, under this condition, this is a range or one point of intrinsic value. And I think this is a way more healthy and realistic way to think about investing, but it's not that catchy, and it's way more uncertain, and it's just, you can't grab it. It's more of a thought experiment, but I think it's way more practical to think about that way than the wrong way, at least from my experience and my perspective.
Well, I love it, because I threw price targets out the window a long time ago. But I had professional experience with individuals that set their mind on a particular price target. And it cuts both ways. I think it's a fascinating psychological study that you can have, right? So let's say you and I found a stock. It was trading at $50. It dropped to 25. We buy it at 25. We do the math. We build a DCF, everything. And we say it's a $60 stock. And the minute it actually gets to 60, you're in a very peculiar position. Because on one hand, you feel right, vindicated. I don't know how to describe it. It's like, I got it right. It's like that kid at school that knew the answer is 2 and he got to the 2. But what do you do at 60? What do you do next? Well, you bought it right. So you took advantage of the contrarian moment of some temporary issues that brought the stock down to the 20s. It ran up to 60. What do you do next? And I think mentally it's very hard to continue to hold on to the stock past the 60, because you set your mind on the number.
Yes.
And I think there's still a lot of money, potentially, in some cases, left on the table. And you might want to choose to let your winners run, which is another question I have for you. You talk about the path dependency of investment risk. And I like the word risk because I think it's a very tricky to understand concept in investing. But talk to me about this idea of letting your winners run and the path dependency of investment risk. Sure.
Where that comes from, and I think, like you mentioned it, like, what is the concept of risk? And where I came from is, it's more about, let's say, investment philosophy, but the discussion between how do you manage a portfolio and how do you assess your risk management. And you have basically two camps, and you say, okay, you can basically have a diversified portfolio and you rebalance. So you say, if something's down, you put more into it. If it's up, you take it out. Or otherwise, like, you have like your some people refer to a coffee can approach. You put everything down, you never touch it again, and just let it ride. And what I try to do, and this, like, can I get from both angles, like, what does the math say? How can I get the mathematical concept behind both approaches? And this is what I set out to do, and this is also what the article was about. And if we first start with, let's say, you regular rebalance, and if you think about what is risk, you want to minimize risk. And I think investment theory says every investment has risk, and the risk can be divided in two portions. The one is the security-specific risk. In case of a stock, it could be a bankruptcy. And then you have a systemic risk, like a large liquidity event like in 2008 and 2009. And what you can do in the first one, like the only free lunch in investing, it's diversify. You can diversify the business-specific risk away, and you cannot diversify the systemic risk. If you're long only, then this is why you should command an adequate rate of return, so that that compensates you for the risk you take. And if you think about risk in terms of volatility and up and down movements, this absolutely makes sense. And if you think about risk as a constant factor, that absolutely makes sense. And I put the math into the article, but if you say, okay, I invest into a business and you have a 5% risk that capital is permanently impaired, so it goes bankrupt or you lose a lot of money and then it never will recover. And if that risk is constant 5%, over a long period of time, it is guaranteed that the risk will materialize. Because, I mean, what is the survival probability? It's 95%, and you compound that 95%, and math says if you multiply a number between 0 and 1, and it goes to infinity, like it approaches 0. I mean, that's a mathematical fact. And if you think about it, then it makes sense to rebalance and diversify, because you want to escape this probability and this event. But what I came from is, okay, surely there is business-specific risk, but I think most of the risk part in an investment is subjective to the investor. So what do I mean with that? If you think about risk as permanent loss of capital, there are two ways to think. First, I mean, it really goes into bankruptcy. I mean, this can happen. But on the other hand, it's if you sell out of a position that is down, then it's permanent loss of capital. And what I'm convinced of, and what I think also if you study like very successful investors, is if you can hold on to, even if you're down, and can really play the long game, you can mitigate that part of the risk. And this has something to do with conviction, and this is subject to the investor. And what I said is, okay, if you now agree on that risk is not constant, but because you can learn about a business, you can get more comfortable, you can actually reduce your specific risk in that investment. And I found a very elegant mathematical expression. It's from a mathematician, Leo Pochhammer, and it says, okay, if we start with 5%, and let's say we can reduce the risk every year by a constant factor. Let's say we can halve it, because we keep on learning. And if you multiply that series, so you start with 95%, and because you learn more, you earn 97.5, and so on. I mean, we don't have to go into the math. It turns out that it doesn't approach 0. And it actually can, if you can minimize it to a very large degree, like you have a very high proportion of not losing your money. And this is actually, and I found it very interesting, because that would speak to letting your winners run. And I think it has very interesting implications to portfolio management, because every time you're considered, like you have one position that maybe ran up a lot, you own for 10 years, and you have but maybe the expected return is not that high, and then you have a new idea that might be more exciting, that you learned a couple of months ago and you studied it. Like, what should you do? I mean, if you just look at expected return, like obviously you should pick the new one, because it's a higher expected value, so you should buy it. But if you now look at the concept, like you have had 10 years of basically risk reduction in what you currently hold, and you start from let's say your initial risk of, let's call it X%, and now you have actually a comparison, because even though the expected value might be higher, you have this risk of permanent loss of capital, because if you buy it now and it goes down 50% in the next 6 months, how high are the chances that you're holding it if you just learned about it? And I mean, the math is nice here because it proves it, but it's not, you shouldn't put the numbers, but it helps to think about it. The longer you hold something and the more you learn, the more comfortable you are, and I think the less risk you take. And yeah, that was basically what I came about. And yeah, that's why I think risk is way more subjective than objective. But it's way less tangible if you think about it in a path-dependent way.
I like the transition from stock picking to building a portfolio, because it's a different framework. people get into investing, they find a stock, and they know it will go up. Sometimes they're right, sometimes they're wrong. I think it's helpful to lose money on the first idea. But anyways, at some point you start to think of a portfolio, right? It's a collection. It's like you pick players for the team, a soccer team or whatever it is, right? And here you pick a team. And there's no limit. You can have a team of 10, you can have a team of 4, you can have a team of 30 or 50, whatever you feel like is right. And there are layers to it. But when I think of risk, to me, a very initial idea definition is a loss, a permanent loss of capital. I bought it for 100 and I didn't get the 100 back. Even when I get $5 out of the 100 back, a 95% loss. To me, it's as close as it gets to a total loss. Wrong investment, right? It's a zero. I like to talk about avoiding zeros, and I brought it up in this podcast many times. But to me, it's very important that in that initial phase, when I'm making a decision to add something to the portfolio for a client, if I can imagine it going to a zero, I don't want to have it in the portfolio. And there are a couple of ways that it can go to zero, right? A huge leverage, a questionable management, and a business in a secular decline. Like in big buckets, at some point, some of those ideas have to belong to all of them or one of them. If you have a lot of leverage and the business is going for a tough spot, it can dance around bankruptcy, right? So it could be the equity part could have a massive loss. If you have questionable and even fraudsters running the business, this could be a total loss. And I've seen it more than once as an observer, not as a participant, out of curiosity. And I think that the last part is tricky. We talk about temporary. I think it's very tricky in the investment research process to say that if it's permanent or temporary, right? So you might have a dip in sales and a dip in earnings, and you say, well, this is passing. But you might be ignoring that the consumer preferences shifted. You might be ignoring that there's a better competitor. You might be ignoring some secular, as in permanent shift, right? And I think as value investors that are looking for a deal, I think that's a dangerous territory for a lot of us, that we think that something is cheaper, but it's only going to get cheaper and cheaper and smaller and smaller and smaller. I think that's a dangerous place. And I think that shift used to take decades. And now I think it will be an accelerated shift where the change can happen within a few years and the business is no longer what it used to be. So I think that's fascinating. When I was listening to you, I was thinking of Thomas Bayes, the mathematician. Have you spent some time doing some research about the work that he did?
I mean, I'm obviously familiar with Bayes, and he's the godfather of conditional probabilities, and that's hugely influential. Like I mentioned, like also with the probabilistic outcome, you have to say like it's the price target, like I mentioned, is $50, but it's way more helpful to think under the condition that the business executes, like the competition remains the way it is. The intrinsic value would be around $50. But right. And then you have the range of conditions, I think. Thinking in probabilities and updating those probabilities as you go. I mean, that's what Bayes statistics is about. It's a way more practical thing, or a practical approach, like to thinking, and also like on statistic, actually, like more, like as computation, the more computational power we have, the more actually the statistical models go into Bayes probability than frequentist probabilities. So yeah, it informs my decision making, let's say.
I've been spending more time rereading some of his work and interpretations of his work, but in my big picture interpretation is the idea that you continue to learn, right? So if you and I sit down and we say, today it's a 50-50 chance that it's going to be a rainy day, right? Okay. But if we look outside the window, we see that there are dark clouds coming, right? So we continue to learn and have more inputs, prior knowledge, right? Then maybe it's actually a 60% chance that it's going to rain, right? And on and on and on. I think in investing, I think seeing it as a more dynamic rather than a static experience allows us to continuously tweak and course correct as we go. And I think it's a big revelation for me, especially if you have a longer time horizon. So you have the time to course correct, right? So you went in and you thought that this is a $50 stock, but then after it ran up from 25 to 50, you realize, look, they were in 5 markets. Now they're in 20 markets. They had 200 people in Salesforce. Now they have 1,000. They tweaked how they reach the end consumer. I have reasons to believe that the sales per salesperson will go up by this much, right? And you continue to tweak it. That's why the probability of success or failure, right? It's something you can continuously study. And I think it's fascinating because we see a research report as a picture, right? Like, there you go, $50 stock. Well, and I think you're missing the point. Like, it's a movie, you know, it's a dynamic thing, right? Yeah. I mean, in Geico that Buffett bought decades ago and Geico today, it continued to change and evolve. The environment that it operates in continued to change and evolve. You have to adjust your expectations, and hopefully you're adjusting them on the way up. If you're adjusting them on the way down, you might want to exit the investment. But I see it as an ever-changing living organism. And that's why some of those numbers, you know, math ideas, I think allow me to interpret the reality in a different way and continue to learn and adjust.
Absolutely. And I think this is also like where some of my philosophy comes from, because you mentioned, like, I think a very famous example in our recent times is Amazon. I mean, Amazon started as selling books online, and I think even in the early years, if you read the letters, I think Jeff Bezos, like, his vision wasn't to not only sell books, but there was no chance to predict AWS, like no chance to predict it. So, and I think you, at some point, if you choose to invest, like what you actually want, and I think where the large part of the returns come from is the unpredictable. Mm-hmm. And it's also like my philosophy is like I want to pick businesses at prices that have optionality. And if you think about it, like I want, like you can say, optionality is surprises to the upside. And I think there are two parts to it. The first one is the business. You want to be in a business that actually has the criteria, the characteristics to surprise to the upside. But you also want to buy it at a price that doesn't price in those optionality in it. This is where, like, I like to buy businesses where I can say, okay, the market thinks this is just an average business and it won't sustain their returns on capital for very long. So you can think, okay, and then I like, okay, but if that's true, I can get, even because the price is suppressed, I can get like my cost of capital back because that's what's priced in. But I think that this company has characteristics that is actually, that it can sustain, like it can survive and not only survive but thrive over the long term. And this is where I think you get the optionality, and this is where you can earn the returns. And I think it's a business and a price component to it. And I think this is where the rewards come from. And maybe an example is, I don't know if you're familiar with Novo Nordisk. I think the GLP-1, one of the manufacturers, and I was one of my, not my first one, but one of the first 5 stocks, like at least one that I made money on, I must say. But it was back then, it was, I think, around 20 times earnings and I think 80 times cash flows. And it was a very simple thesis because it grew like 7 to 10% with the diabetes market, and you have the duopoly with Eli Lilly. And I said, okay, if I can get the free cash flow yield with buybacks and dividends, and this just grows with the diabetes market, and I think the diabetes market will grow, and you can earn a pretty good return. And I mean, this business has an extremely long history of innovation. And I mean, I had no idea about GLP-1, like no chance, but nobody had. And then, like, look at the past 3 years. I mean, it went through the roof. And if you look at it now, I mean, now it grows extremely fast. But I would argue that even though the business clearly has optionality, like the price has put it's in the price already. So this is why I'm way less confident now that you will earn good returns going forward, because even though the business has optionality, if it's so highly valued, like same with NVIDIA, it's so highly valued that it's already in the price. So what becomes optionality, I think it comes to the opposite, and that's tail risk. I mean, now it's like if they won't succeed for 10, 20 years, like you have a huge possibility like that with a re-rating and you lose money. So like I really like, because you mentioned it, like to think about optionality, like what is already there and what can happen from here that you cannot predict.
What I'm hearing is buying tailwinds at a discount.
Yes.
So, and it's harder to do than it sounds, right? It's easy to describe, but it's very hard to imagine. But when you think of the upside, and you mentioned the coffee can portfolio, so let's pause for a second and come back to it. I think coffee can, for the audience, for the benefit of the audience, there's a study that you can look up, and somebody basically was buying and never selling stocks. So it became this very awkward portfolio with very large positions in the most successful stocks. So the purchase decisions were right, but there was no selling decision, which allowed them to capture this very uneven, very strange portfolio, but of huge successes that other manager would have trimmed by now because the position is too big. So there's a lesson there. And I think one of the lessons is that you could find those ideas that have an extremely long runway. So you have to have an extremely long time horizon to benefit from that. And I had Chris Mayer on the show who wrote a book about 100x, and it's a repeat of a study of Phelps from years ago, 100-to-1 stocks, basically trying to identify ideas. And it's an aspiration, right, to find a stock that will go up 100 times. But finding a stock that will go up 20 times or 50 times, I think it's also impressive. But you have to give them time. You have to let the winners run, as you mentioned. But I think the big idea behind it all is that, look, you were right that the stock went from 25 to 50. But now that stock can go from 50 to 500. How about you stay on that bus? And I think that's one of the hardest things for investors to do.
Absolutely.
Stay with them, right? So
yeah.
I like this idea that everybody can buy a stock, but very few people can hold the stock. I think that's the biggest difference. Buying is easy. You can buy it on your walk from your phone in an app. Buying is easy. Holding onto it, that's the hard part. And volatility that you brought up, that some people consider risk, volatility is what shakes people out of ideas. You thought you were right, but it's down another 50%. To hold on through it, it's very hard. And it's hard also when it ran up 5 times and it's down 20% from the high. It tests you again and again. So you have to put in place different ways to limit your reactions, knee-jerk reactions to the price action, so you can actually hold on to stocks. David, I want to switch topics to AI. You recently wrote a paper that you were very generous and you shared around, and I had a pleasure of reading more about your thoughts about AI. But from your perspective, you're a data scientist, you work with a lot of data, you actually use AI as well. Tell me about your experience so far, and what's your perspective on the process? I think we're dancing right now. Will humans be replaced? Can this empower us? Will this get us in trouble? What's your perspective on AI and how you use it in the kind of work that you do?
Yeah, happy to share that. I mean, as everybody else, even as if you work with the technology, I mean, everybody's impressed, and so am I, about how the capabilities of Gen AI, and especially like how fast it came, and how we're slowly seeing that how to leverage it to actually use it, because I mean it's fun to play around with it, but I mean to put it in a to use it in a productive manner is a completely different thing. What I'm urging on, if we bring it to what I wrote about, I mean, first I wanted to educate about what generative AI is and what AI is in general, and like who will benefit from it and who maybe won't. And first of all, like I don't know. So as anybody else, like everybody else who knows it, he or she is lying to you. So it's more about how to think about it, and maybe to put it in perspective. AI is more than only generative AI. And this is where I made the distinction. I mean, I think many people are familiar with machine learning models, like we had your training data and they were specialized models, you trained it, and then they could do a specific task. And I think what the huge impact of generative AI is because these are these broad application models, because they trained on language or imagery, and now they can do a whole range of tasks. And I mean, it's impressive, because I think it's that impressive because it reminds us of how we think and how we do things. And I think that's what we find truly impressive, because if you have one model that can do one very specific task incredibly well, I think we're not that impressed, because we think, okay, this is an agent that can do one thing very well, better than a human, but it's one thing. And now we're thinking, but machines will take over the world, because oh my god, like this thing, like it can everything that I can do, like faster, more accurate. And I mean, it came a year ago or 2 years ago, and I mean it's rolling on with no end in sight. And I think many people, some get way too excited and one way too afraid. And what I put in perspective is these are like the way these models are trained, and not to get too deep into the technical details. They are just like you put with large language models a whole lot of text through them, and they predict a word in a very simple thing, like they complete a sentence, and then and they do it at scale, because you can as it happens, like it's very easy to come up like to hide words and put it through the model, and with scaled computing, as the video provides, and the algorithms are there, like you can scale these models, and this is why they're so impressive. But you have always to think about these are generative models, and I mean, I think many people know about hallucination, like that at some points they will just make things up. I think you have always to keep in mind these models were trained on just completing sentences, and that's what they do. And because, I mean, it's amazing that you see emergent behavior. I mean, you just basically fill in the gap, and now they can, like you could almost say they can reason to some point, but I would be very cautious about that. But like what they can do that is not directly encoded into data. But still, like these are generative models. Like you wouldn't, or it's unreasonable to use them in any high impact, or like in a environment where you have decision making under uncertainty, or any environment like that. Because you think about it, like these are just, they're generative. Like it's not with traditional AI. I think they were actually from a setup more. You could, if you can control the data and you can control the training, you get some statistical guarantees for the data you trained on that the outcome will be what you would like it to be, like precise. And like there is no way to do it with Gen AI, because that the model is not trained to optimize a criteria other than make useful, produce useful language or produce useful imagery or video. And it's very impressive, and I think you can use it in a lot of ways, but it's only one applicative field, and I think where people miss it is you cannot assume that we have that, and the next step is we have like automation, and that's not how it works. Like the algorithms are there, and it's not clear that Gen AI is even the thing to artificial general intelligence, like what many people talk about. And I think it's very important to distinguish. I mean, you can use this tool, it's an impressive tool and you should use it, but I think if you use it in a wise manner, like it won't replace you, because it's still not capable or not reliably enough to base decisions on that without double checking. And you can argue that generative AI will never be, because you cannot get the certainty that you can get otherwise out. So that's what I brought about or want to discuss, because if you have, I think it helps the framework to think it fills the gap and it does it at scale, and this is why it's so impressive, and this emergent behavior is impressive, but it's trained on that, and that's what it does, and it's no control about different things, and this is why unreasonable things happen at some point. And the second thought was, okay, we are investors, so we think about, okay, who will benefit?
Right.
And I don't know, but what I thought about, what are the possible scenarios? And I basically had three possible. The first one, as many people think, is you have the hyperscalers, Amazon, Microsoft, Amazon, maybe Meta and Google. They have all the computing power. They have the data, or at least they claim to have the data. That's a different topic. And they can train these huge models, and scale wins. And if you can put out the impressive capex numbers that they do and buy all the chips, and then you can compete. So in this sense, and if they find a way to monetize AI, which they currently not really have, then you would say, okay, these will be the winners.
Right.
But that would only mean if they find a way to monetize those large language models, and if there is not a way to compete, because again, like Meta, for example, put out the model, you can download a large language model and train it yourself. And that's if the trajectory goes on. You like I mentioned, I'm very skeptical about that. I think as there is so much innovation in AI, and it will change again, I'm pretty sure. And I think a huge part is the data. And if you think, there is already in Europe, there is you had the EU AI Act, which demands way more transparency. And what I mentioned, if you think about how the model is trained with just fill the gap, and you actually don't know where it pulls the information from. So, there is a reason why those models, if you bring me the source, usually they cannot, because it's not in there.
Right.
And that's a huge issue. And also who actually owns the data. I don't know if it was the Financial Times or the New York Times. I think the New York Times sued OpenAI because they used their data. And you could really argue rightfully so, because the data is actually where the information is, and they just crawl the internet. And I think regulation is likely to be way more strict on the access to data. And now now everything changes, because now they own the computing power, and they know but the algorithm, is like many algorithms, like the llama model from Meta, is open source. You can use it. So now you can ask, like, maybe the one who profits is the one who has the data. And the framework I like to think about is, if I can find a business that is not tech native, maybe manufacturing business, but that has like their proprietary data and is just very smart about using AI and gets like, you have this first mover advantage and basically can reduce costs and reduce prices maybe, and then can take market share. I think this could be the next step, like businesses that adopt and can protect their data and train, because I mean, like, it's just in the end, if you don't own the data, I mean, it's just a commodity product to train the model at some point. So maybe they will profit from it. And this is more a first mover advantage, maybe. But this is what I would more like. I try to focus on businesses where I say that it's more tech enabled, but not tech native. And if you can do it in a smart way, I think you have a huge advantage. Because if you think other ones just cannot move, because if you're not set up in a way to profit from data as an organization, I mean, you have a huge disadvantage. And finally, okay, if we go another 5 to 10 years, every business has adopted AI, and everybody uses their proprietary data or maybe sells their data. Then at some point, like, I mean, it's the same with the steam engine, electrification, and also like the internet. I think you can argue that almost every business now is an internet company or a tech company to some degree. And what usually happens is in the end, like, it brings all the benefits to the consumer because it's lower cost. And then the entire benefit is with the consumer for lower prices, better service. And this is basically like the last frontier, or like where it may end up. But I mean, this is a lot of speculation. But if you look at markets, I think markets like are almost 100% sure that it's the first case, like big tech will win, or not big. But I don't think it may be, but I'm way less on the 100%, so way down there. So and we think about optionality, and I think like I'm not sure. So I focus on if you focus on the other part, I think as an investor you can find interesting stuff there.
I think it's a fascinating topic, and the fact that it keeps coming back in so many conversations that I'm having with people from so many different fields interacting with the phenomenon, right? And I think one thing is that we've had AI for a long time. I think now it's the AI that we interact with so directly because we can almost have a conversation with it. But airline tickets have been running algorithms and deciding how much to charge you based on the data that they have. And actually, there were funny moments during the pandemic when the airlines had so little data about a specific flight because the demand collapsed. They didn't know how to price certain tickets. And I don't know if you experienced that, but I've seen it, how the same ticket could be $200 or $300. The algorithms were jumping all around because they didn't know what the demand is, right? Yeah. So it's all about the data. So I think that's one thing. The second thing, you brought up the word source. And I find it fascinating. I've been drafting a bit of an article. I think it will become an article about the source. And it got inspired by a book about history that I'm reading. It's a world history book. And it's a different world. I think the author is Philip Parker. And it's a history book where the history becomes the hero of the story, because we usually pick up a history book and it tells you, that's the person that lived, they did this and that, started this war, built this empire. But he says in the book, how do we even know this? And he goes back, who told us about it the first time? And we go back to the old, historians from 2,000 years ago and the first book that ever recorded anything about it, and so on and so on. But going back to the source is fascinating because you realize, how do I know for sure? And a lot of online research until AI was going to the source. You would go to the paper that did the study about the coffee can, for example, right?
Yes.
So you would go all the way. Who actually did that study? When was this study done? What kind of stocks were in the coffee can portfolio? And on and on and on. You get to the source. And I think it gives me as an investor a lot of comfort. And when people say this was a good quarter, to me it's a meaningless statement. What does it mean? What's the context? Good relative to what? And I want to get to the original filing. I want to read it. I even want to listen to how the management told me the story about this quarter or this year. I want to hear their voice on a human level. And I had guests on the show where we talked about the fact that you want to actually, as a human, you want to hear the voice. When they say this was good or bad, if it's a transcript, you lose 90% of the information, in my mind, in some cases, in a highly sensitive moment. I want to hear the voice. How did you tell me that? Did you underpromise and overdeliver, or did you do the opposite, right? So that's, I think, fascinating. The last thing I want to mention here is...
one point was
go ahead.
interesting. One of my holdings was because, I mean, they had a bad quarter or 2 bad quarters, and what they did, because it's a small company, they usually just report once every 6 months. And they initiated a quarterly call because they wanted to address the topic, and it said like basically they want to rise to the occasion and basically say, okay, now things are not moving in the right direction, but like we know the problem, this is what we do, and we just wanted to stand up there. And I think that this is a huge signal, because I mean, this is nothing that you can read in the filing, because like, they actually did this. I mean, it's very easy to hide, but they just stepped up and said, okay, this is the issue we have. Like, we usually don't do quarterly recordings, but this is, or calls, but now we are here because we know it's difficult, and this is what we do. And so I think this is a very valuable information that it's not tangible.
You want to actually hear it, and exactly. I think in that case you appreciate that the management went out of their way. I have 2 more questions for you that I really want to get to before I let you fly away, but the one point I wanted to make is that I would apply a bit of Thomas Bayes here, his ideas that we're going to continue to learn as we go how this develops, and it's not necessary for us to make some static bet one way or the other. I think it will become a part of our reality. I think it might be a little bit like the internet, that it became such a part of our existence and way of doing business that we don't even talk about it, right? The fact that you can book an airline ticket standing in line getting coffee, which you ordered with an app on your phone, and on and on and on, right? Internet is just part of the experience. You assume it's available. I'm pretty sure that AI will become, in some shape or form, just part of this network of a business and life experience in some way. And much more than we think, and at some point we won't even bring it up. We don't even, you and I mentioned that this conversation is happening over the internet. We know it's happening over the internet, right? It's like breathing, exactly. Right? Exactly. Like you don't mention, hey, I caught 5 breaths since the time I started giving you some thoughts, right? Like you don't even talk about it. I think AI will become that kind of air that we operate with. Some new businesses will be created. I think some businesses will have a harder time in that new reality. I think that's pretty certain and pretty obvious to state. I'm very curious to watch it as much as you are. I want to ask you more about a human experience of investing. And I know from my own experience that investing can be a lonely pursuit at times. We sit down, we read, we talk to our clients, however your life is set up. But I don't think that the solution is a large investment committee. I think that nimble, reactive way of operating is very helpful, especially if you want to make a difference and be closer to the ideas and your clients. But at some times, there are many times when we need a sense of community. And you and I found VALUEx. Can you talk about your VALUEx experience? What's it like? What it's been like for you so far, and why you think that community is needed in the pursuit that you have in front of yourself?
I mean, first of all, I mean, it's an incredible privilege for me. I mean, I talked about my background. So before I contacted Guy Spier actually, and I mean, his incredible, generous way, the way he is. I mean, he invited me. So, I mean, for me, as being an outsider, like being available, like to all this very, very kind, generous, also brilliant and experienced people like you, Bogumil, and then now we're here talking. I mean, it's still unbelievable to some degree. And yes, I completely agree with you that it's very important to have a community, because the larger part of my investment career, I did it by myself. As I mentioned, there's no investment history in my family, and I mean, playing football doesn't expose you to investors usually, and also like studying math and technology, like it's not I didn't find any other that share the passion, and my wife cannot hear anymore if I talk about stocks. Like she said, talk to someone else. So I mean, it's hugely important to have a network and people you can share ideas with and also get criticism, because if you think investing is a very weird profession, because first of all, if you think about if you're a doctor and practice medicine, like if you do a surgery, you have your action is very closely related to the outcome.
Right.
But in investing, like as we talked about, it's probabilistic, and then I think everybody knows an investor who has been right for the wrong reason, and you think like
Yeah.
but you cannot say. And on the other hand, like you have very long feedback loops. It can take years until your investment decision turns out, and if you have nobody to talk to, I mean, everything you have is to wait, and like it's a very long wait to learn, and also like to get ideas. And for me, like the VALUEx community, it opens so much. I mean, I found new friends there. Like I have people I talk regularly to. I mean, we met, now we're talking and having like a great discussion. I mean, it's hugely valuable to me, and I'm incredibly thankful, and I feel very privileged to be part of this, quite frankly. Yeah, so I mean, like, what has your experience been so far? I mean,
well, first of all, I'm grateful to have a community in my life. I think it's very helpful. And I think Guy Spier has done an incredible job attracting incredible people from so many different fields and across ages and countries and backgrounds, which creates a certain environment, and he sets a stage where there's no agenda. I mean, there are things we were going to talk about, but no agenda in the sense that I've been to so many events and conferences where somebody's buying your lunch, basically, right? And here you buy your own lunch, and you come to to listen and learn. And it's a safe environment, and I think we all need it. It's a very lonely pursuit. It's a very intellectual, in your mind kind of pursuit, but it's also very emotional. And I think on that side, it's very helpful to have people that will do different things than you do, but have the same principles, the same mindset. And you mentioned in the beginning of this conversation how value, broadly defined value investing, resonated with you, and this philosophy, contrarian cash flow investing, just worked for you. It clicked. So meeting other people that do the same things, and then you know that their portfolio is completely different than yours, because it's such a personal pursuit, right?
Absolutely.
And it's fascinating how it works. And I love the fact that you mentioned the feedback loop. I think it's two things about investing that are tricky. I think you can have a beginner's luck, and if you're doing a brain surgery, you will not have a beginner's luck. I think the odds are very low. I think Bayes would agree with us here, right?
Yeah, definitely.
You can't just get it by accident, right?
Absolutely.
It's a very technical thing, and you know how the patient is doing. And in investing, you might just pick the right stock at the right time with even the wrong information for the wrong reasons and still make money. That's why I think it's a peculiar pursuit. But then, on the other hand, you don't see the outcome sometimes for a long period of time. And to have a community that says, you're not crazy, I think it's very helpful. And to know that there are other people operating this way. And I think at the end of the day, as long as you see investing as ownership of businesses, you own businesses, I think it's a great filter. It takes a lot of the noise out of the conversation. David, before I let you fly away, I want to hear about your definition of success. I love that question. I think it gives me a glimpse of how you operate, how you think. How do you think about success?
I mean, I know that you ask every participant, so sometimes I thought about that a lot, and I think it's a very, very difficult one. And I mean, I think my definition is a little bit different to many of your guests, because I mean, I turned 28 in a couple of days, so I think I'm like 15, 20 years younger than many people, and they are way more advanced in their lives and careers. So I'm still in the process of building. I'm starting my career, and I have some years of experience as an investor, but I'm most degree I'm starting. So my definition of success is I want to follow my ambition, like to really become a great investor. But I think if you look around, and many successful investors are really, like you can say, extreme people. Like they took a lot, they took a toll on their private lives, and that sacrificed almost everything. And I mean, I have a small family, and my definition of success, following my pursuit, being ambitious, follow my ambition without sacrificing everything else. I want to be part of my family. I want to see my kids grow up. I want to have a good or a great partnership with my partner, and be a great investor. And I think it's incredibly difficult. Like maybe I can admit that I'm not very great at the moment at doing this, but I want to learn, and I think this is why it's my definition. Because if I can look, if I'm 70 or 80 years old and can look back and say, okay, I've done a great job learning about investing, become a better investor, but also I have a functioning family life. My kids want to visit me. I'm in good physical shape. I spend time in nature, and I've still a marriage. I'm married to this woman. I think this would be a great success. So this is how I would frame it, more in a process than a destination. Like if I can get there, like this is what I would describe as a successful life.
Well, I love the sound of that. And we started with playing soccer or sports in general, but the idea of the game that you choose to play, right? We're all playing our own game. I think it's interesting to pause for a second and realize, what's the game that we're playing? And we might be sucked into the wrong game for the wrong time, for the wrong period of time. But to actually pause for a second, what am I trying to win here, right? And is it really about winning in a traditional sense? And you make an interesting point, and William Green brought it up in his book with when he talked about Charlie Munger, how Charlie Munger said look how many of us ended up divorced, and I'm happily married like you are. And I was thinking about it because I love investing. It's my passion. And, even falling asleep last night, I was reading about a company that I haven't looked at in a while. I can't stop myself. I'm curious. I think the answer is curiosity. I'm just curious. But I don't want investing to get in the way of actual living. And I think a better life leads to better investing, and better investing leads to a better life. I think you can't choose one or the other. And I hope I never have to choose one or the other. And I like the way you described it, where at the end of that long journey, I wish you lived to 100 some years or more, that you can look back and realize all of those pieces that I wanted to have worked out the way I wanted them to work out, not just the fact that you've been rolling this snowball and it's a very impressive snowball. I hope it is too. But the journey itself was enjoyable and fun, as much as this conversation was.
Exactly. No, exactly. I mean, it's always about sacrifices. I mean, at points you have to choose between, you prioritize different things, but in the end, it has to be some kind of balance. You cannot always be on the one side. So that's what I try to incorporate, take seriously.
And I think at the end of the day, it will make you a better investor. That's my assumption. I think at the end of the day, if you have a happy life, you went for a nice walk, you had a nice dinner with your family, I think this will lead to a better investment decision. I think if we see it in a more holistic way, I think we realize that there's a win-win-win all around.
I'm
David,
100% sure.
This was incredible. Thank you so much for your time. I really enjoyed it. I'm so glad we were able to make it happen, and I appreciate your wisdom, generosity, and I wish you best of luck on your journey and many, many decades of success on all the fronts.
Thank you. I mean, I wouldn't call it wisdom, but I mean, it was a whole lot of fun. I think you asked some great questions. I mean, we had a great discussion. So I'm I feel privileged to be on the show, and I mean, I would always do it again. And thank you so much. It was great. And I hope the listeners got something out of it, and it was worthwhile listening.
I know I did, and I'm sure the audience will love it. Thank you, David.
Thank you so much.